Hello and welcome. My name is James Smith. Thank you for joining our regular quarterly update. I'm joined today by Grant Patterson, founder and CIO of Providence, and Will Porter, head of investment strategy. Welcome, gentlemen.
Thanks, James.
Thanks, James.
Grant, I might start with you. The most recent quarterly outlooks, we've had titles such as Seismic Shifts, The Tide Has Turned, and now Disruptive Times. And we had a quote, markets are vulnerable to a sharp correction. Could you just talk us through what you mean by that?
Well, James, I think we've been pretty consistent over the last 12 months that we felt that valuations in all markets were stretched and there was a lot of exuberance in markets, and we were a bit concerned about markets running ahead of themselves and the valuations. So we have been purposely very diversified and defensive, if you like, because we felt that the markets were vulnerable to a correction. It's been very quick with the S&P down probably 15%, NASDAQ down about 30+%. So it's been very quick, the correction, and we still think we've got some way to go yet. It's important to understand that the structure of markets over the last decade has changed quite substantially. I mean, in regards to the equity markets, you've had the rise of the passive fund where money flows from retails have gone into the index, which means that the index continues to buy the same stocks, which tends to overshoot on the upside. That's also the reverse when there's a lack of confidence and people taking money out of markets, that the same stocks keep getting sold. So you can overshoot also on the downside. Plus, you've had a number of participants leave the market because of regulatory changes, where we used to have investment banks holding inventory or market makers holding inventories. They're no longer part of the market. Plus, you've got the large institutions that have grown their unlisted illiquid investments over the years, whether that be through private equity or infrastructure, which means that if they wish to take advantage of the listed market volatility, it's much more difficult to do so because you don't have that liquid capital available. So there's been quite a number of changes, and that's why I think, you know, the speed of this correction has taken some people by surprise.
Yeah, thanks for that. And looking ahead, there's a lot of focus on inflation, and there's now concerns about economic growth, and even the words recession have been used. Could you just articulate what your thinking is around those three areas?
Yeah, well, there's certainly been a lot of dialogue in regards to inflation, and we've seen a very high headline rate around the globe, which is causing some concern, and that's obviously having impact on central bank policy and bond rates. We've got to remember that inflation is the rate of change, and we feel that after the last disruption that's occurred in supply chains and what's happening in Ukraine, that headline rate is probably peaking at this sort of level. But we do believe the underlying input prices or prices are going to remain elevated over the coming period of time, and that's in wage costs, that's in food, that's in fuel. So and of course the supply chain. So inflation may decline in the rate of change, but we do think that the input prices will remain elevated. Now that's going to put some pressure on growth, the outlook for growth. Companies are going to see higher input prices, wage price inflation, so that's going to put some pressure on corporate earnings or in regards to margins. The household balance sheet will be under pressure because of those increasing input prices, plus, of course, the higher interest costs burden for your housing mortgages. So we think that there will be some pressure on growth, and after the last decade of above trend growth, we think that we're going to be potentially going below trend. And that then starts bringing in the question about recession, about whether there's the potential for a recession down the track. Definitely the probability of a sharp downturn, you know, late 2024 is increasing. Whether we have a recession or not, I don't know, but I do think we're going to see quite difficult environment in the year ahead.
Thanks for that, Grant. That all sounds a bit concerning. So, Will, with portfolio construction, where are the opportunities and the risks?
So I'll start with the risks. We still think there's risk in credit. So despite the equity markets having sold off, we've still seen very little movement in credit spreads, which to us is just a little bit of a risk at the moment. We're also seeing very little effect on corporate earnings at this stage. So we think, you know, there could be some downgrades to come still with corporate earnings. But more importantly, on the opportunity side, we're quite attracted to Australian government bonds at this point. So we've already seen a significant number of rate rises incorporated into the government bond yield curve. So we're seeing that there is some opportunity there for portfolios. We still have a preference for Australian equities over international equities. Australian equities are generally a little bit more protected from the input price inflation. We're a commodity producer, which is very baseline of input costs. So for us, that's reasonably attractive. And again, as I mentioned, international equities still haven't reflected any sort of earnings downgrade yet. So we're still a little bit more of a preference for Australian equities. We still think there's opportunities in the niche property sectors. So primarily for us, that's regional hospitality and disability housing. It's been an attractive asset class for us historically, and we still think there's opportunity there for our clients.
And so, Grant, have you got anything further you'd like to add with regards to portfolio construction and risk?
Well, James, over the last 22 years, our major focus has always been on the protection and preservation of capital, and that was true in the dot-com boom and bust, through the GFC, through COVID, and I think that still remains the same. Remaining in quality assets, quality companies, being nimble to take advantage of the opportunities that come around, and being very diversified is very important in that environment. And as Will's pointed out, there's going to be some great opportunities in this dislocation. We're quite excited about the opportunities that will arise, but you need to be very disciplined and very patient for those opportunities to take advantage of.
So, Grant, how does this environment compare to previous downturns that you've experienced?
Well, James, over my 40 years in markets, it may be different this time, but the result will be the same. We've seen an enormous amount of exuberance in markets and quite a lot of volatility. I mean, the fever pitch buying of technology companies, indiscriminate across the board, was unbelievable to us last year, and you've seen that through ARC Investments that has fallen now some 80% in value because of the underlying investments in technology. And we also saw it very clearly in crypto, where there was a huge amount of exuberance in markets. So certainly the greed factor that's always around in markets was alive and well towards the end of the year. So, it may be different, but the result will be the same. Valuations have got to come back to realistic levels whereby they can generate cash flow, generate profits and generate some dividends. So it's different, but not, if you like. And I think it's really important during this sort of period to have experienced people behind you and to keep an open mind. And to that, over the 22 years, we've had a very experienced investment committee that helps us navigate through these periods of time. And as Will was pointing out, it does throw up some pretty exciting opportunities. So I hate to say that I've enjoyed seeing a bit of a correction, but to be honest, it's shaken out some of the froth, and I think it'll show some great opportunities that we'd like to take advantage of.
Thanks, Grant. And just with that in mind, Will, some of those opportunities for portfolios that you see?
So some of the opportunities we're seeing, at the moment we've increased Australian government bonds, and what we've seen there is pricing of rate rises from the RBA getting quite excessive and relatively well priced into markets. So we think there's actually a good opportunity to make some capital returns, and also a much more attractive headline bond yield that we're getting out of those securities. So that's one place we're finding some interesting investments. We're also going to stay with this preference for Australian equities over international equities. So the Australian market is generally more of a beneficiary from this input cost inflation. So we are commodity producers, which is a sort of primary asset into input costs. And also we've seen a little bit more of the earnings downgrades be represented in the Australian market, which we haven't seen offshore yet. So as Grant said, there could be some input costs that we're seeing offshore and some margin compression. We haven't seen that be reflected overseas yet. So while multiples have come back and are starting to look a little bit more attractive offshore, we actually haven't seen the earnings downgrade impact as yet. So with that in mind, we think Australian equities look a little bit more attractive at this stage. And of course, we still see some opportunities in niche property sectors, which has been something that we've been quite interested in for some time. So we've got some regional hospitality assets, and we're seeing some other opportunities in that space also. And finally, we still remain attracted to these asset-backed loans. So making sure that we have high protections in there for investors, so low LVRs, and also getting a very interesting yield out of those investments, or an attractive yield out of those investments.
Thanks, Will. And coming back to Grant, are there any updates you'd like to share with us on Providence?
Yeah, thanks, James. Yeah, there's been a lot going on behind the scenes. We're delighted to announce that David Watts is joining Will and the team as equity analyst. And David joins us after quite a number of years' experience in markets, so David will be beginning pretty soon. Ben Sullivan, that's been working for us for some time, has just graduated with his double degree in commerce and economics, and we'd like to congratulate Ben on a great effort and achievement. Also, something that we've been working on for some time, we're delighted to announce and have formally announced the formation of the Providence South Australian office, which has opened last month. Got a great team of people in Adelaide led by Tony Michaels, and that's a great addition to our structure and our offering. So now in Sydney, Melbourne, of course, James, with yourself, and now in Adelaide. And we're also very delighted that our client lunches are back on in person, and we're very much looking forward to seeing our clients in person in June for those lunches.
Thanks, Grant. Thank you, Will. Thank you for joining us. We look forward to seeing you soon and sharing our thoughts and views with you in the future. Thank you.